One.
Greetings and welcome to The Extraction. Today, we'll be talking about financial frameworks for business, that's module 6. And more specifically, we'll be drilling into lesson 3, which is the cost control and profitability, also looking at critical success factors. The content would begin with an introduction, definitions, managing cash flow. We'll move on to the critical success factors, case studies, and then wrap up. You have myself, Unzube Ufodike, and my colleague, Bex Wanwudu, who will be running you through this.
Aye.
Thank you. Do bear in mind that the conversation would focus more from a business standpoint, as you'll see from our introductions, and not from an accounting perspective. So we are talking about managing cash flow from the entrepreneur business standpoint. Still speaking with your financial advisor, still accountant to go down into the nitty-gritty. My background is quite varied. I studied at Queen Mary University and University of Nigeria Enugu campus, and I've worked for nearly 20 years here in London in the city within large financial institutions from Henderson Global, UBS, Cazenove, PIMCO. I'm also on the board of a few company charities. I do some angel investing, and I'm one part of Money Ready. Over to Bex for a quick introduction.
Hi. Hi, everybody. My career, I've educated in the UK, and then I had a city career, actually raising capital and trading financial instruments, which enabled me to really understand in depth how they work. And then moved to Nigeria and lived in Nigeria for 15 years, where we raised over $300 million for Nigerian companies and worked on over $1 billion of transactions in Nigeria, which was great fun. Right now, though, I'm really looking at the renewable space, tech space, SME space, how to help African companies really scale up and make sure that they can actually benefit from the new world that is emerging post-COVID. So moving on to the next slide, which is about the definitions. So we talk about the balance sheet, we can look at the income statement, and we look at the statement of cash flows. Now, when we're talking about a small business or even a startup, they may not even have these things. So you've got to project what it's going to look like in the future. But for the balance sheet is really the snapshot of the company where it sits. It looks at the assets, the liabilities, and the equity or capital that's been put into that business. It's a snapshot that says we have assets, we funded those assets using these liabilities, and we put this equity in place to also help grow the business. The income statement is your kind of running rate, your scorecard, how much revenue you're bringing in, how much costs you're paying out, and then what you're left over with. Is it a profit or is it a loss? It's quite straightforward, but this shows you where the business is growing. Small businesses tend to make losses, and obviously as they grow, they hope to make profits. That's the name of the game, really, in the whole business space. The final document is really the statement of cash flows. Now, the cash flows are actually slightly more nuanced from the income statement. You can make a profit, but you can actually not have the cash. And that's very important to track where your money actually is, because running out of cash can mean your business comes to an end. So when we look at the statement of cash flows, we look at the cash that's generated from operations and operating, cash flows generated by investing, and that's really fundraising as well. And then investing rather, where we put money in the terms of trade, and then the cash flows generated by financing. And that's really where the money, some funding sources, equity investments or bank loans and stuff like that.
And thank you for that definition, Beck. So that tells you some of the technical fields to remember when you're looking at balance sheets, income statements, and statements of cash flows. A simpler, more visual way of recalling these aspects, I like to think of a balance sheet as a snapshot. So it's that picture that tells you exactly where things are right now or at any given point in time. Your liabilities, your assets, and what's your equity. So you can see that image. It's striking. You can see the parts of it, but you can't really tell the full story. You just have that right now instant Polaroid. An income statement is where you have all the special effects. Think Ratnik, District 9. It's with a lot of things happening that don't necessarily tell you exactly what has happened, because depending on the accounting principles you use, there's a lot of film trick inside that income statement. So
Yeah,
when you see an income statement, just think of it more as a film with all the special effects. A statement of cash flows, I look at that as a documentary. So the documentary unwraps the layers and gives you the real narrative, because at the end of the day, if cash is coming into the company at a rate that's greater than cash going out of the company, then you have a profitable business. It's not a matter of financial engineering and accounting trickery to make you profitable on paper with the film tricks. So just try and remember the balance sheet, Polaroid, the income statement, film tricks, special effects, and a statement of cash flows as a documentary. If we move over to the next slide, I'll talk through a little bit more about some of the techniques and the aspects of managing cash flow, again, from a business perspective. So first, that assessment that has to be done around the requirements is super important. Looking at the forecasts, making sure you have a good grasp of all the cash flow drivers and all the assumptions, and that will give you a better mapping of the things you need to pay attention to. You move on to scenarios where you plan for best, worst case, and other scenarios. That will give you a better sense of what events can trigger particular cash flows and what the management response should be to that particular scenario. We need to also have a framework that controls how credits are given, how money is released within aspects of your business. You need to have policies around who can issue money above a certain amount, what 4i checks you might need to have in place for certain transactions, how invoices can be reviewed and approved, etc., etc. Within the working capital bucket, it's about focusing on reducing that operating cycle of working capital. We'll talk a little bit more about that in the cash conversion cycle. So this is where you optimize your inventory and your account payable. So looking at the cash conversion cycle on the right-hand side, here we could start with stage one, which is where money goes out. When you're starting any company, you do need to pay out cash to purchase inventory to get your inputs that you will then convert into products or services that you can sell to your customer. So that process, initial money out, can be funded by many different ways. In a future course lesson, we'll be talking about how to fund that aspect of your business. So money going out in stage one. Stage two is how you manage that output or outflow of cash. Your accounts payable and payments to suppliers, you can structure with terms that are more favorable to you, the vendor or the supplier, the company that's actually issuing the request to a supplier. And the final phase is where you hopefully get money back into your company. You will have sales. Your products and services go out to satisfied customers who then pay you in cash or other forms of payment. You go through account receivables and collections. And it's making sure your receivable terms help you better manage cash flow. You don't want to have payable terms where you pay to, for example, your customers, or sorry, you pay to your suppliers within, say, 14 days of receiving the goods, whereas you receive from your customers with 45-day terms. Then there's that cash flow gap that needs financing. So thinking about the payable and receivable terms, you need to get that invoicing right. That'll better manage your cash flow. There are automated invoicing systems to use to improve turnaround times and reduce delays to sending invoices, and also to remind your debtors that they do need to pay. It's also worth looking at liquidating any cash that's tied up in assets, because any inventory that's not being used can quickly become obsolete. Finally, building a cash reserve for a rainy day is essential. There is a lot of unpredictability as you own in companies, and you don't want to encounter a situation that forces you to have a fire sale, or even worse, go into administration. So having the cash reserves or a cushion would support and mitigate against such. If you move on to the next slide, I'll quickly talk about some critical success factors. We've already highlighted the time value of money. And here, what we're looking at is a little bit more around how you can extend payments to suppliers. If you can keep more money in the business longer, that is always of benefit to the company. Try and renegotiate contracts. There are lots of cash management tools and cash financing providers to use, so you can get inventory or assets without having to pay cash upfront. That would smoothen out your cash flow and make it such that there's less disruption to the business. If we click again, Bex, the second aspect of critical success factor are the relationships. Business is a contact sport. Any individual you're interacting with, if you have a better relationship, it helps you to exercise that influence over the desired objective. For instance, and many people have said this, if you have a particular customer or a particular client that you have a significant cash flow expectation from, you need to become best friends with whoever works in their accounts department. That way, whenever they see your invoice, they can prioritize and make sure that you get paid first. Or if they need to spend an extra 30 minutes overtime to get you paid, they will do that for you. So it's all about the relationships. That way as well, if you do encounter hard times, people that have built a trusting relationship would be able to extend favorable terms for any financing agreement based on the credibility of the existing relationship. Another and the final critical success factor before I hand over to Bex to give some of his remarks is around the execution. So thinking about the wider picture, when executing, yes, you need to manage and conserve cash, but the environmental, social, and governance frameworks are super important. You can't avoid paying for a chemical spill cleanup because you're trying to reserve cash when it's going to damage the environment, it's going to damage your reputation, you're going to end up with potential legal costs and liabilities that exceed the amount that would have covered the chemicals spill cleanup. You can't treat your staff unfairly and pay peanuts where you're conserving cash as a business, but you then end up with people that only stay for a short time. There's a high turnover. You can't retain the institutional knowledge to grow the company because people are just abandoning ship. You don't treat them right. You don't have the correct frameworks that take care of their welfare. They'll move to another company that does. So thinking about, the triple bottom line, as it were, is important when managing cash flow. It's not just about holding onto all the money you can, but distributing it in a way that invests in the people that will be running your company, preserves the environment, and supports a governance framework for success. Bex, would you like to add to this critical success?
Yeah, I really would. I mean, I think this is a great slide, and cash management is so important for businesses. I mean, looking at the time and money from another angle, we always say, is this the right time for that spend? And also looking at every spend and saying, does this spend generate revenue for me? And so when you start looking at spends through the prism of it generating revenue, you might think about an economy class flight versus a business class flight. You might think of the kind of marketing that you do, whether it's plain awareness or whether you're actually investing in customer acquisition and customer conversion. As Nzube said, when you're buying your cash management systems, an investment in cash management that enables people to, reminds people to pay you on time might be more valuable than even picking up an extra bunch of new clients. So it's very, very important that with time and money, every decision is looked through that prism as, does it actually generate me cash today? Is it necessary right now? In terms of relationships, treat people kindly and, try and build people up so you have that reservoir of goodwill around your business that enables you to retain more cash in your business and get people to do things for less cash up front. That's actually very valuable to a business as it grows. It could be getting your business a partnership with a new distribution network where instead of having a huge fee up front or a huge fee per unit of distribution, you might be able to defer that for a period of time. And that allows you to be cash generative and have cash sitting in your bank account rather than their bank account because you have that relationship. It's very, very important. Also in execution, where we're talking about ESG, we can't compromise there. You can't talk about building a business whilst you're damaging something else. So it's very, very important that you find ways in which your cash management and your management of your funding and finances doesn't harm or damage the environment or the people around you. I mean, that's all that I wanted to add on to it. So moving on to the slide.
Yeah. Yes, fantastic. Let's move on to the next slide where we'll talk about practical case studies, because it's one thing, with theoreticals, but we thought we'll come up with a few, contextual based case studies. So I don't know, would you like to take Conga, Bex?
Yeah, let me just talk about that situation. I mean, Conga is a very successful story in Nigeria in terms of the fact it raised an amount of funds. It built up e-commerce in the region. It proved that it could work to some extent. But what happened with Conga, despite the funds that it raised, its backers decided to exit somewhat earlier, simply because in terms of its burn rate and its ratio to becoming profitable, it didn't become profitable, and they gave up on that story. Now, Conga's story is actually transformed, where it was bought by a local business, and it's now making it profitable and scaling it up within its platform. So making sure that your burn rate, the amount of cash you're spending versus the time you have, it may not always be a bad story, but Conga did have the successes in fundraising. But where it ended up, it had to end up selling the business to a local business, which has now built that business even further.
Indeed. And one interesting thing I'll just add about Conga is because of the type of business environment it operated within, it had to look at many other aspects of the value chain and invest in other aspects of the value chain that were not necessarily immediately revenue generating. So that also affected cash flow. So thinking about keeping lean models and focusing on a niche is a luxury not every company can afford. And sometimes it can, the chickens can come home to roost. The other example I'll give around managing cash flow here, I'll zoom in Hopin. For those that are not aware, Hopin is also an event management platform. Both Zoom and Hopin in the last 12 months, due to the global pandemic, have grown tremendously, not just from usage statistics, but they've also grown their bottom line, the cash flow revenue from customers, their top line. They've gotten a lot more capital from investors. And what made them quite unique? So with Zoom, it's been around for over 7 or 8 years. It started with a customer-centric problem. The early investors that came in Silicon Valley were backing the company because it provided a solution that allowed communication seamlessly, that was more affordable than a traditional phone or any other system communicating internationally. With Hopin, the founder himself, Johnny, had this challenge where he due to ill health, was unable to access events. So he spent a couple of years while he was bedridden working from home and building stuff for other companies. He spent some time building his own company where he created a solution that allowed people that couldn't access venues interact in a more engaging way than just a seminar where you are being spoken to. Within the last 12 months, Hopin has grown from a company worth a few £1 million to a company that's worth over £1 billion. It's the fastest growing company in record.
Wow, that's amazing. I think that's just the truth. Customer driven growth is the way forward and is obviously the best way to grow a business. And also those two examples were businesses that were always primed for their opportunity. If you're a business that's ticking along nicely, there'll come a moment where everything is aligned, the moons are aligned, and you can really, really leap on that growth. And that's what both of those examples have done. The final point we want to make on this slide is really about the business environment that your business is in. Now, managing cash is all about managing risks or being able to survive shocks or having capital to be able to take advantage of opportunities. Now, that depends on your business environment. The two images we put there, one, obviously the lower image is like the Western traffic and Western roads. Yeah, there's a traffic jam there, but it's very organized. They've got lanes, you've got traffic flowing in one direction and the other direction. When you look at the image above, it's the African situation, and it's slightly more chaotic. There are many more risks in place. And what you find as an African business is that you have to reserve and preserve more capital to self-insure yourself against business challenges and business problems. So things like, what if there's no electricity tomorrow? What if staff can't arrive at the office because of a transport problem? Obviously the pandemic has happened, and that pandemic has happened in Africa without the same level of government support as the pandemic has happened in Western countries. So African businesses typically have to self-insure and preserve much more capital at any time. And what we would suggest is that a business has to kind of do an audit of that, maybe once every couple of years, once every 3 years, look at how much capital it's actually preserving just to self-insure. Do we have 2 generators or 3? Is there a service that we can use from a third party? How much diesel do we have in stock? How many staff do we have just to do this job? And can we outsource this as a service? If we do this audit maybe once every couple of years, you can actually, or is there even insurance available at this time nowadays for this thing that I'm self-insuring for? And what you actually realize is that you can keep optimizing your balance sheet and your cash balances over time to make sure your business remains lean and effective, and that the cash that you do have can be used to jump on new customers when the time comes.
Indeed. Thank you, Bex. And so we're at the end of this presentation. Time has flown so quickly. What we've done is run through some definitions, given some practical tips on how to manage cash flow. We've also described, in our view, some critical success factors, as well as layered some practical examples with case studies. This summary slide here is just a visual representation of all of that. And one way to think about it is, when managing cash flow, think about the internal and external factors. So internally, the micro factors, if you like, your organization, your information and technology, the systems, the people, the processes. You need to make sure these are smooth, streamlined, and you're on top of things. On the macro, external factors, if you like, it has to be a sustainable business. Looking at the external shocks and factors that can affect the planet, profit, or external people, stakeholders, would ensure an equitable, viable, sustainable company. So thank you for your attention, and we look forward to seeing you this weekend when we go through the Q&A. Bye for now.
Thank you. Bye-bye.